Hi, so while the judges make up their mind what's the prize winner, we thought we'd tell you a few things about venture capital and our view of what's going on in the market around a few particular issues. Before that, I think we'll start by introducing ourselves. My name's James Savage. It says on here I work for Hendale Capital. I don't. I used to. I actually spent most of my career, I've been here in Hong Kong since 1994. I've been a venture capitalist since 2000 here in town. And at the moment, I'm in the middle of putting my own fintech fund together. But the other hat I wear, a charitable sort of hat, is I'm the chairman of the venture committee of the Hong Kong Venture Capital Association, which is an incredibly long way of saying I'm sort of chairman of the industry body here in Hong Kong for the venture capital firms. I shall hand on down the panel for them to introduce themselves, and then we'll start on the question. G, please.
Thanks, James. I'm Jia Gong. I'm a partner with the global private equity and venture capital fund of funds, Pantheon Ventures. Pantheon collectively manages over $34 billion of institutional capital in the PE and VC space on a worldwide basis. So my responsibility is primarily on the Greater China market for fund investments as well as co-investments. And venture is a significant part of our portfolio, roughly about 15% of exposure in Asia is in venture. And within the venture space, fintech is increasingly important as a subsegment. So happy to be here to share our perspective from a fund investor's lens.
So my name is Dusan. I'm the founder of Global Ventures. I did my entrepreneurial exit in 2004 in an internet bank called Mona Bank, which is today is part of CIC. So that's how I made my money. And after that, I've been exclusively investing in B2B fintech for the last 10 years. I've done 18 investments, so it's only 2 to 3 per year. 9 of those have been exited and 1 positively exited, and 1 has closed down. In particular, I would say that I've been an early-stage investor in something called Shares Post, which basically creates liquidity for VC-backed private company stock.
Howard.
Hi, I'm Howard Lindzon. I spoke yesterday. My exit was Wall Strip, which was a financial video show that CBS acquired, and I've been angel investing before and after, and now we are in the middle of raising our 3rd fund. I do financial services, but we also do enterprise software.
So it's a pretty interesting mix. Some Hong Kong investors, some China investors generally, some specialist fintech people, and some more general views. I think the question we should start off with is one we often start off with panels is sort of what sectors are we interested in the way of fintech? Let's restrict it to fintech, being as it's the basis of it, that we think is going to give us good returns from now. Maybe go along the line, and probably we'll start with Howard. He's got a more sort of maybe North American view of things, and we'll sort of work our way back this way. What do you see as your sort of key investment themes over the next year or two, and what's you think is going to make money?
Yeah, well, at the top down, there's 2 things that could happen, because in the United States and the rest of the world, young people, everybody's chasing those people, but they don't have money, and they may, in Japan, it may be 2 more generations. In the US, it could even be 30 years before these millennials get the money. But they have to learn. So from a bottom up, I'm focused on onboarding younger people, either through savings, active investing, education. So that's how we think about the investing pipeline, very early stage, North American. But we have made investments overseas as well. And so, part of it is finding founders that understand the timelines of fintech startups and understand the domain, how difficult this domain is.
Yeah, so maybe I didn't mention it, but so at Global Ventures, we are 40 partners. We invest in Beijing, Hong Kong, Singapore, the Bay Area, New York, Paris, Berlin, Stockholm, London. Another thing than money, we basically, over the last 10 years, have built relationships with about 1,000 financial institutions. So the thesis we have right now, it's a couple of things, but I would say the top 2 is blockchain and AI. I really think the timing is something that I've learned the hard way. I didn't mention it, but actually my second-owned company went bust. The 3rd one went well. And the timing is critical, and I think we reached that timing piece that actually, there is not just a small need, but there is a real need of both blockchain and AI. So these would be the top two areas that I look into.
Yes, I agree with.
Okay, who's got their phone?
I agree with what my fan.
Okay, try again.
Somebody clearly does not like what I'm going to say. But actually, I hold no controversy here. I agree with what my fellow panelist has just talked about. I think AI in our portfolio has been the area that quite a number of funds are very focused on hiring the right talents and doing the right connectivity with the US, top academic institutions, and other resources that are likely to be able to contribute to this. And blockchain is another area that we see increasing attention. But I'll add a third one, and specifically for China, robo-advisors. The Chinese high-end, high net worth individuals are reasonably served by the private banks. But as the need to preserve wealth, to invest well, permeate with the middle class and also those that have savings but are less affluent, I think robo-advisors are likely to play a bigger role in how younger people finance or make their investments. And there are a few idiosyncratic reasons why this could actually witness quite rapid development. Traditionally, banks have been very much focused on the corporate sector, so personal finance, personal investment really hasn't been a key priority until recent years. So I think infrastructure-wise, that side has been underdeveloped compared with the US or Europe. And secondly, as the interest rate in China, or the overall yield return environment continue to see mild decrease, there is just less margin for the failures. And that tend to drive more app-based robo-advisor type of service rather than heavy touch personalized services. So those drivers are going to create some wind in the sail in the area of robo-advisors.
Just to be a little bit controversial, I don't believe actually in robo-advisory. I do believe that it's a huge market, but I think it's a very, very crowded space. I don't know how many robo-advisory guys have just reached me out here today. I'm going to Shanghai on Monday. So I think if you are doing robo-advisory, you've got to have a twist to it. It's got to be a little bit more than just robo-advisory the way we know it. It's got to be solving that problem, but also something else around it. It could be linked to AI and other solutions, but it's got to be a twist on the robo-advisory because there are just way too many just saying robo-advisory and what else on top of that.
There you go, controversy from the stage. My other question to put back to you is, we're all sitting here in Hong Kong, and we've got lots of North American people and whatever on the panel, and maybe a lot of the audience actually are from pretty wealthy countries, but we're trying to cover the whole of Asia here, and we've got a pretty substantial unbanked population in Asia. Do we not see any value in solutions for those guys along the way? No one named it. I'm quite surprised by that. Are you against it or just didn't think of it?
Well, actually, the blockchain piece is actually the financial inclusion that I'm looking at. So I'm looking at the interoperability between, how do actually these underbanked people actually get into something like a mobile phone and actually solving that interoperability for them. So I think, those, AI and blockchain are just technologies. But if they can enable to solve the financial inclusion problem, that is actually really the sweet spot. So can you get the data from an AI perspective so that you can easily score these people, so you can easily get them on board and bank them?
Gee, and are your funds sort of mentioning that to you? Are you hearing that? Or China's now actually, we have this debate a lot, but I think actually consumer banking in China is probably ahead of anywhere else in the world these days, right? So the problem probably isn't in China, it's other parts of Asia, but what do you hear?
Well, I think China has come a very long way from the Union Pay starting in the 1990s to the online, the third-party internet payment to P2P since about 7 years ago. So there has been waves of innovation that enable consumer financing, and I think that trend is really driven by the theme of cost saving more efficiently reaching out to a larger scale of population. So, I think that, you're going to see iterations really enabled by breakthrough in technology like blockchain that will increasingly cut down the cost and to ensure the efficient delivery of financial services to the less served. It's really a function of how low the cost can be, and then, what's the break-even point for a marginal product to be able to reach to an audience that's less affluent.
Great. I think we'll move on to the next question. And this is one I get accosted with a lot, I think, and that is, is the venture capital community in Asia actually supportive of fintech? This generally comes from the venture companies. My opinion is, yes, it is. We're very, very keen. I think I would say in various geographies, and I'll talk particularly maybe myself first about Hong Kong and then head it to the panel for the rest. The ecosystem of venture capital, the same as the ecosystem for startups, is still developing. It's certainly in Hong Kong, it's not fully developed. Everyone appreciates that. I think how I would see that is, I think actually, and this is open for debate, and we can have a discussion about it, but my view is actually there's a fair amount of angel money knocking around in Hong Kong. There's a fair amount of mature money, so by that I mean money above $10 million in a deal. And there's an amount of sort of angel money up to about $1.5 million, maybe $2 million. But actually, at the moment, we have a significant shortage. I won't say an absolute gap, but a significant shortage in the gap in the middle. And that's to do with our ecosystem. It's just not there at the moment. And it's sort of kind of matching the weaknesses also in the ecosystem here. On the positive side, I think China's going pretty well, right? I mean, we've got the whole system in China. Gee, maybe you can help us sort of get a view of that.
Well, I think I agree with your observation. There's a vacuum in the middle. And the reason is that really, I think it's a function of number one, the age of this fintech concept in its current version. And number two, the funders for those businesses. At the larger end, I looked at a top 20 fintech businesses in the world, I think by KPMG. For 2016, China has 4 out of the 5 largest fintech businesses, Alipay being the number 1. And so, in a way, the BATs have been able to channel tons of capital into these areas, and they see this as the tomorrow of their business. At the smaller end, I think there are lots of startups, and we actually see a pretty healthy dose of fintech businesses backed by early stage venture capitalists. But those will take years to grow to a maturity that become interesting to be either snapped up by a trade buyer or even longer to go into IPO situation. So right now there's a vacuum in the sort of C round, D round, but then you do see business like the installment financing business. I think it's Chudian that has got F round. So there are examples. It's just very rare given the vintage of this concept.
Dusan, I mean, you look at a lot of different markets clearly from what you mentioned earlier, and we're talking about particularly, so what you say, Greater China subjects. How do you see it in the rest of Asia and how that relates to the rest of the world? Maybe Howard can address the US, but
I think I mean, Asia is a little bit difficult to kind of cover in one sentence like that, but definitely China is a part, right, in terms of maturity and everything. I think India is, for me right now, the absolutely most exciting part of Asia with the demonetization, obviously linked to that, what I talked about earlier, blockchain and AI. So I think there are arbitrage things to do. Like if you are from Hong Kong, or Indonesia or the Philippines, maybe the easiest money in the beginning is actually in Singapore because it's a lot of government money there. So you kind of go there, get the early money there, and then you go back to Hong Kong for a little bit later stage. So I think there is arbitrage things and I think that's why these ecosystems should work, because there's definitely a little bit more of a little bit later stage of easy money here compared to Singapore. And I think it's very important to kind of knock that out in terms of when you are an entrepreneur, how you actually do your funding strategy, so you don't sit in Hong Kong and wait for a big A round, because I don't think it's going to happen actually.
Yeah, fair point. That's it. I know if we actually look at some of the companies I think that have been across the stage today, some of them have done exactly that. Some of them have got the first round of funding in Singapore, come up here, joined an incubator here, and then gone after a bigger check, right? It's happening, so someone's getting the message, but interesting feedback. Very, very different problems to what you have in the North America, I would think.
Well, our problems, we don't have the same problems, but we're going to have the same problem because, as you were saying, 4 of the 5 biggest financial products are in China. So in the United States, we kind of live in this little bubble, especially in fintech, and we're protected by the SEC and FINRA. But if we don't come, I'm here to learn and to watch and to see it. You got to take those baby steps. But Asia's coming into the States, right? So now you have J.P. Morgan, Goldman Sachs that got through the crash. But everywhere else, Alibaba could come into the United States and take over the whole brokerage industry of the millennials, whether it's under their brand. I mean, Goldman Sachs started that I forget the name of the thing that they started for consumers. That means nothing to American people if Alipay comes over and does what people need it to do. So I think what you're going to see is if people like me aren't coming here to learn, it'll be too late when Asia comes into North America from the financial perspective. And then you have blockchain speeding that up. And once someone solves identity, that's a global thing at many levels on the blockchain. So we've made some investments there in the United States. So it's a pretty exciting time. Listen, I'm small, I think about North America, but as a founder, I'm like, whoa, I can't believe it hasn't been more acquisitive. So I look at this in the United States, and I look at fintech companies over the last 10 years, and yeah, I've sold one, but I'm shocked that I haven't sold 10. And maybe it's because the banks were paying fines for the last 10 years and worried about regulations and loading up on regulations and paying lawyers. But during that time, Hong Kong, everybody's had you've got your own problems, but everybody had a chance to build up their war chest here for what could potentially be a move into the United States.
Yeah, I want to sort of actually then move on the conversation as a carry on from where you are. I think the next question we were asked is think about sort of valuations and timescales and exits. Now, Asia is a massive market with lots of different valuations, and I don't really actually want to get into the valuation question because I think it's too broad against the range of different sort of series and geographies. It could go on forever. But I think one of the things that is worth and interesting to discuss is, and maybe we could start with you, Dusan, is how long is it going to take to get some of these people from the seed stage companies that we're beginning to see, this first time we see them, to a fully mature exit here in Asia? And what is the time scale? Are the entrepreneurs, we think, being realistic about how long it's going to take to get to an exit? Maybe you could start with that one.
Yeah, I mean, my statistics are a little bit old, so maybe it's 1 or 2 years old, but 80 to 95% of exits in the US and Europe, are $20 to $25 million. They're never VC backed, many of them. So I think, no, in general. Fintech, I don't even have the stats on, yeah. But because it's too new as an industry. But I think what we need to realize is that yes, we read in the press about all these VC series A, B, C, D, E, but the majority of companies are actually gonna be done and gonna be sold, and many of them won't be VC backed. Some of them will, but these are the kind of the superstars that actually attract that kind of VC money, and it will always be a small percentage of the total, right? So as long as everybody as an entrepreneur gets around it, and I think, I'm building something that is very attractive, I might not be VC backed and I can still do an exit, it's a very good story.
So I'm going to push you.
Yeah.
Timescale. How
well,
do you see the timescales,
so
right?
what I'm saying, if you build your own company, then, you control your destiny a little bit, right? You're making it profitable sooner than if you would do a VC. You can sell it within whatever, 5, 6, 7, 8 years. Maybe 10. But if it's VC backed, what we've seen there, and that's actually also my experience from SharesPost, a private company stay private longer and longer and longer. So this was a US phenomenon that started, end of 2000 with Facebook, Twitter, LinkedIn. Then it moved to China recently, 3-4 years ago, and now it's in India. So these kind of really, really top companies, they stay extremely long. It's even longer than 10 years. And that's why we started to actually create liquidity for these VC-backed companies, so that the early stage guys like us, or even former employees, existing employees, to some extent can get some liquidity, maybe especially former employees, get some liquidity in an EF round, start a new company. And then you actually really have an ecosystem that what really works around, right?
I mean, we were having a PE conference yesterday, and this is one of the big discussions there was actually we call this a trading from one firm onto a second firm during the lifestyle of a company, you know, a secondary, right? And how much support and depth there is here in Asia for secondaries. What do we think?
I can only give you the U.S. example, although I have invested in Israeli companies, is Americans like to move fast in terms of deals. I'm not saying China doesn't move fast or Asia doesn't move fast at that level, but just in terms of like packaging everything up and getting it out the door, we always were the fastest. Now we're playing catch up. What I liked about the American spirit of this stuff is, and it's changing, the greed's increasing because this boom's going on a little bit longer, and we're all now ending up in deals with people we didn't want to be in deals with, companies or brands that we hated, because these exits are taking longer. But everybody has to be more realistic at the beginning when there's this backup. So I think, you know, we're all reading the same people, so we have this fancy idea of what a cap table should look like and what a note should look like. And I'd like to throw that all out the window here before the market corrects or crashes and say, I've invested in companies from LifeLock that had to raise a lot of money, took 10 years, but sold for $2.4 billion. And everybody made a lot of money, even though the first valuation was at $4 million. And that took 10 years. I invested $100,000, or we did $1 million on two in Buddy Media not that long ago, 2007, and you know, the founders still made a lot of money, even though they gave up 33% at the beginning. So you got to choose your investors wisely. You really have to think about your cap table early on. That's a global thing. I don't think enough founders, they get so excited about their idea. You know, you really get one shot at that pie. And if you really believe in it, there's a million ways to skin the cat. And I don't think enough thought's being put in at that early stage. You know, you got safe notes, and you got angel lists, and you've got corporate VCs, and I think there's a global rethink about how people need to think about this. Because how you structure it at the beginning is how you get out of it at the end.
I agree.
I'll add that in Asia, I think the ecosystem is actually richer in fintech than in other segments of technology world. The reason is that I see quite a number of banks, traditional banks, take a very positive view towards this, not as a threat, but as something that can help them lower their acquisition cost of customers. So, you know, in Singapore, DBS, for example, and Standard Chartered have their own innovation and acceleration programs to encourage and promote fintech businesses. And I think the ultimate reason is that they want to actually acquire those companies if they see them as a nice bolt-on to their existing business. And let's face it, the big banks still have the advantage because ultimately they have the data for their customers. And the data is really the key underpinning of the success of analytics, and a lot of the stuff we talk about, they need data to support the ongoing success of those business models. So my feeling is that there's, other than the traditional VC and the capital market, of course, there in the BAT, there are also the banks that are looking into getting their feet wet in this area. Of course, they rely on a lot of the external energy and talent to create models that are readily pluggable into their system.
I would completely agree on that, Jesse. The corporate ventures and corporate insurers in Asia is definitely filling that gap that we might be missing in terms of traditional VCs here.
I think one of the scenarios, and I'll put this out there and shoot this down if you don't agree, you know, the way I saw it sort of 3 or 4 years ago, we had a lot of very young entrepreneurs who thought they could seize the world of financial services because banks were rubbish and they were slow. And we had a load of bankers who thought, these guys don't understand banking. They have no idea about regulation. I don't even want to talk to them. I think we've got to the stage, I think, over the last year or so in Asia where they're actually talking to each other, right? And we're getting to the point now where actually useful businesses are being built because they're willing to talk to each other and we're getting something done. But for me, just knocking into the exit, what that does is it means that a lot of those businesses are actually going to end up being B2B. They're dealing with other businesses. So that goes to our timescale issue that we were talking about. And also, you know, that means that they're going to be trade sales, right? I don't see many of these entities actually, you know, going out into the market. Now, what I would turn now into another question is, when we speak to entrepreneurs, do you think entrepreneurs get that in Asia? That they've got to look for themselves to be bought, or are they all looking to try and get themselves on a market?
I would add, I wonder if investors get it as well. Because, it's very easy to invest money, right? But then you actually have to get out of that investment. So it's actually not only the entrepreneur's problem, it's also the early stage guy's problem to actually find that exit together. So I think actually it's kind of, so to answer your question, I don't think the entrepreneurs get it, but I don't think really the early stage investors get it either. I usually say that early stage investors like me, we usually spend 75% on finding the deal and then 25% on the rest. It should be the converse, 25% on getting a deal and 75% on value and exit. So I think it's actually an ecosystem challenge. And I think, the pricing, if the pricing is not right in the beginning, which is done by people that have priced before, which is pre-VC, then the VC prices correctly, and then you get an exit. And that mispricing can actually create a lot of problems for the exit trader.
I mean, exactly. If in the States, that's my job, and I will say it here. I will take emails, I will look at decks, I don't know everything, but I do know pricing, and I do see everything as an investor and AngelList too, and that's my job. So I try and spend 75% of my time, or 90% of my time on the value and on the upside. We know how to price stuff, whether it was Chart IQ, who came to an accelerator here and is building one of the biggest charting back-end libraries. We did that round at $1 million in the US at under $1 million pre. Wall Strip, which I sold to CVS, was $600K pre. You can still make money, but you have to understand in fintech that it's just not like any other industry. And that is an investor problem. That's why I think our fund has had success, but you have to get people's expectations in line. That's how the stock market works, and that's how this works in up the food chain, is if the expectations on the entrepreneur and the investors are off, the whole thing could get tilted off.
I heard a classic comment actually just before the new year. Someone told me this. Has come back from a trip to the Valley, been talking to a load of the big Valley firms, and they one of their senior guys turned around and said, "No, we've been looking at this fintech thing for about 18 months, 2 years now. It's great, but we've just worked out that regulation is quite a big thing in the financial industry." And I'm like, well, where have you been, guys? It's always been a huge driver, right? And
that's
that
why
makes it so different to other consumer.
That's why Robo was so popular, is because you didn't have to go get a SEC registration, and it was just a software algorithm. And now Silicon Valley, after pissing away $1 billion, and I'm not saying it won't work in the rest of the world, but Vanguard's working. I don't know, 250 billion flowed into Vanguard. Wealthfront and Betterment or whoever, these hundreds of they're losing. They never were winning. And if you're going to do a robo, like he's saying, like Betterment did some hard work and created that 401k zero product. So they went from paying that same $400 per customer by offering a 401k. They got, they go to our company and get 30 new users for life by doing some hard work and adding a little twist on top of their robo, which will probably make Betterment an interesting company.
So I'm conscious of noticing time. I'm going to one more question for you. So I'm going to put the mic out there for some questions in a minute, but we'll have one more on the stage first. So, I think we're all seeing that China is actually a great success story. North Americans are here; they're interested in it, right? This is probably storming the leading path for Asia, as in mainland China. Where are the exits? I mean, okay, we've seen the big three guys make a fortune, right? Are there other exits going on there in China that we don't see, or is it all still too young for us to see the real exits?
Well, as you said earlier, in China, I don't declare it a great success story. I think there's a lot of potential, and there are a lot of conceptual reasons why this should be very big in China. But I don't think here and now there are enough money circling through the whole loop for you to declare that entrepreneurs have already made a lot of money, or investors have made a lot of money. But that time is going to come. I would also say something about the regulation point earlier. Through my lens as an investor in VC funds, by the very nature of innovation is always that it will always presage regulatory oversight. Regulatory oversight always tries to play catch up. But it's never the right way or approach to sit and think regulators will support it or not support it, because I see quite a lot of businesses that have become industry leaders take it upon themselves to actively engage with the regulators, communicate with them, preemptively think about what they would be concerned about and what are the other constituencies whose worries or whose livelihoods they need to take care of. I think that kind of engagement and be really an active member of the shaping and forming of the regulation is really the only way to go.
And that's hard work. I mean, I'm not going to, I'd love to argue with you, but that takes a special entrepreneur, whether it's Naval and AngelList, who was dealing with the regulators and got the laws changed basically through software and lobbying and truly digging in. But in America, unlike China, and I've been to Beijing, and Ren's an investor in our fund and in Stocktwits, you know, from the conferences and stuff that I've attended in Beijing, gray means go in China. And in the United States, gray means you have cancer. Like, do not go there. And so that's the difference between the two that at ground level that I see. And that's an advantage for China. I mean, Americans are scared of SEC. I've seen friends get fines from SECs for ideas that the SEC, I can't believe they have the time to focus on some of these 25K, 50K fines, but that shuts down the industry. The other big thing, again, our industry screwed somewhat by NASDAQ. They should be investing in this ecosystem, and they're not, whereas you have the banks actually doing that. In America, that's like taboo. Nobody wants, no entrepreneur wants to do business with the banks. And then the VCs, if the banks are in too early, that scares the VCs off. So you have a big advantage there, and that's where I say, that's where I get worried is like China's going to come in and buy all these companies in the U.S.
We got to wrap it up, but I am going to take one question from the floor. When I put a warning out there, I can't see. There's got to be a hand up out there somewhere. No one, all these great venture capitalists on the stage, and not one question.
Any startups got any questions? Because you've got some pretty good advice here about what to do. Oh,
Okay, over here.
Well, thanks for everyone for giving me a chance to ask this question. Right.
Can't hide behind the speaker, sorry.
Right. So for the startup, if you're on the right track, you're picking up and people are interested in investing or talking about valuations. When you're in the driving seat, how do you know that's the right place or the right valuation, the right time where you want to get out? Because if you start getting funded, or people talk about just an acquisition at that stage, like there's a lot at stake. So when you start getting good numbers, when and how do you get to the stage, this is the right point I need to get out?
I'll take that one first, but I think we should all have a bit of a crack at that one. I think, from my point of view, I'm assuming you've got some money in there already, right? And it's not just you and the other founders of the company. In which case, you've got some angels along who I imagine will have some pretty clear views about whether this is a good offer or not. But I think at the end of the day, it's down to the founder to make his own mind up. If he's got a significant stake in the company, you know, he needs to make his mind up about whether he takes the money and goes does something else, or no, he wants to hang in. But what I would say, usually having been through this a number of times, is entrepreneurs by their very nature, if they're good entrepreneurs, are pretty bullish people, and that's a good entrepreneur. And often they have a more buoyant view of the future than necessarily, the venture capitalist or the investor has. And I would say that you need to find a balance between the two, because that's probably where the truth is.
Yeah, that's a beautiful answer. You have to, if you're 50 like me, everything could break down in your body. So it's your last deal. But when you're 30, or you're 25, you're going to do 6 of these if you're the true entrepreneur. So you're going to get it wrong. The point is you're going to get it wrong. The question is, how wrong are you going to get it? Are you going to be in misery about it? Are you going to be able to pivot within because most companies have to pivot at some point. Are you going to be able to pivot with the investors that you're picking? But you should know going into the meeting what you can live with. What percentage of the company am I prepared if this person says yes? That's the way you should go into every meeting as a founder, is prepare to get a number thrown back at you, because you want to convert that person in the meeting. And if you're in the meeting and you pitch them and then you start talking, you need to know before you walk into any meeting what you're willing to live with. And not enough founders, and you're taking these meetings without really understanding who you're in the room with and do you want their money. But if you're in that room asking for money, be prepared to negotiate and know your number. And, obviously that's advice I wish I had.
Anybody else want to add to that?
Well, I'll
Okay.
just add that an important input in this whole deliberation is actually non-monetary. For example, if you're faced with an offer, you need to think, is there a positive synergy or is there a negative synergy? If you sell it to party A, a trade buyer, your business can be stymied and your remaining stakes will be, diminishing in value. But on the other hand, if somebody actually can create a floodgate of whether it's data or customer and bolt your business on beautifully, then it exponentially increases the value of the business, and your diluted stake will be worth more than the whole pie. So very much it's a function of who you be partnering with and how much value or value destruction that partner is going to bring.
Here is a number for you. When you pitch your revenue numbers, I always discount 90% of the revenue that you're going to say next year. So that means that I'm 9 times lower than you think you are. If you're a woman, I discount only 50% because they're actually much fairer on the numbers. So if you think about that when you come in, then you can find a compromise in terms of the numbers that you want and we want.
Great, thank you very much. Thanks for that wisdom. Yeah,
Okay.
appreciate it.
We're done for time, right? Okay, thank you very much, panel. If you show your applause.
Well done.
Thank you very
Thank
much.
you,